My name is Fatina Emilia binti Abdul My metric number is 1233040. And today we will be presenting about the implications of digital currency for money and capital markets. One major change is the rise of digital currency, including cryptocurrency, stablecoins, and central bank digital currency or CBDC. This currency use technologies like blockchain and distributed ledgers, which allow transactions to be faster, cheaper, and rely less on intermediaries. As a result, they affect liquidity, payment system, investment behavior, and even market uncertainty. Beyond just speeding up payments, digital currency also open up new opportunities for financial innovation, cross-border transaction, and also financial inclusion. They are starting to influence how business and individuals manage money, while also prompting regulators to rethink traditional financial rules. Overall, the rise of digital currency shows how technology is not only changing the tools we use, but also the structure and dynamics of the global financial system itself.
Next is about the first issue, which is cross-border payments and capital market efficiency, Project Dunbar. The global financial landscape is at a crossroads. For decades, we have relied on the correspondent banking model, but it has become a significant bottleneck. This fragmented system relies on a complex chain of intermediaries, resulting in high costs and slow speeds. In fact, the World Bank notes that global remittance costs average 6.35%, and transactions typically take 3 to 5 business days to clear. In a high interest rate environment, the opportunity cost of having capital trapped in these sluggish, pre-funded accounts is simply too high to ignore. Project Dunbar, a collaboration involving Bank Negara Malaysia and the BIS, proposes a paradigm shift. By using a common platform for multiple central bank digital currencies, MCBDCs, we can achieve atomic settlement. This uses distributed ledger technology to ensure that the exchange of two currencies happens simultaneously and instantaneously. By cutting out the middleman, we don't just speed up the process, we reduce settlement risk, lower costs, and provide real-time transparency across the entire transaction chain. This shift is particularly vital for Malaysia's position as a global leader in Islamic finance. With our Islamic capital market valued at 2.63 trillion, representing over 63% of our total capital market, we must eliminate the settlement friction that international investors currently face. Integrating MCBDCs allows for global delivery versus payment (DVP), meaning a sovereign sukuk could be purchased and settled instantly. This aligns perfectly with the Financial Sector Blueprint 2022-2026, reinforcing Malaysia's status as a premier hub for Sharia-compliant liquidity and dynamic portfolio management. However, moving from prototype to reality requires more than just technical success. As highlighted by the IMF, we face significant non-technical hurdles, specifically regarding governance and regulatory harmonization. Central banks must establish a shared trust framework and align complex anti-money laundering protocols across different jurisdictions. Ultimately, Project Dunbar provides the blueprint for a more resilient and liquid financial ecosystem for Malaysia. Participating in this digital evolution is a strategic necessity to maintain our competitive edge in a digital-first global economy.
This slide explains the importance of digital transformation, focusing on central bank digital currency. CBDCs are in importance innovation for Malaysia's dual financial system because they have the potential to be Sharia compliant, unlike cryptocurrency. CBDC can be designed without riba, gharar, and excessive speculations, making them more suitable for Islamic finance. One key advantage is that a retail CBDC does not generate interest or yield, so it can function purely as a medium of exchange, and this makes it more compatible with Sharia principle compared to private cryptocurrency like Bitcoin. However, CBDCs also come with financial stability risks. If widely adopted, funds may shift from Islamic bank to CBDC, which could weaken bank liquidity and disrupt Sharia-compliant money market instruments. Therefore, while CBDC offers strong opportunity for Sharia compliance and financial innovation, they require careful regulation and Sharia oversight to maintain financial stability. Next, this slide highlights both the opportunity and risk of CBDC for Islamic finance. First, in terms of opportunity, CBDC can enhance transparency and efficiency in Islamic financial activities such as zakat, wakaf, and sukuk. Through programmable features and smart contract, transaction can be designed to comply with Sharia principle. CBDC also support key Islamic finance objectives, including wealth preservation, social justice, and financial inclusion. However, to achieve this benefit, strong governance, cybersecurity, and data protection are essential to prevent operational and systemic risks. On the other hand, there are financial stability risks. CBDC system may be vulnerable to cyber attack, fraud, and system disruption, which could affect payment and settlement processes. During periods of financial stress, rapid fund transfer from Islamic bank to CBDC wallets may weaken bank liquidity and increase the risk of bank disintermediation if proper safeguards are not in place. Overall, CBDCs offer significant potential for Islamic finance, but they must be careful managed to balance innovation with financial stability.
Okay, I'll be discussing a major evolution in the money market, the central bank digital currency or CBDC. To understand the why, we have to look at our current two-layer system. Right now, the physical cash in your wallet is central bank money, but the numbers in your banking app are actually a private liability of your bank. A CBDC changes this by offering a digital form of legal tender issued directly by the central bank. This isn't just another e-wallet. It is a foundational shift that allows every citizen to have a direct, risk-free digital relationship with the central bank. This is crucial because it ensures our national currency stays relevant in an increasingly private, crypto-dominated world. Next. Okay, next we are going to the main point of the issue. First is boosting policy effectiveness. First, with direct transmission, central banks can adjust interest rates directly on digital wallets, making policy changes immediate rather than waiting for banks to react. Next, real-time data, DLT. Properties allows for instant monitoring of money velocity and economic surveillance. Last, breaking the bound. An interest-bearing CBDC could allow central banks to implement negative interest rates more effectively than physical cash. Next point is critical risk, banking and stability. First, discrimination. If the public prefers risk-free CBDCs over bank deposits, commercial banks lose low-cost funding. Next, credit crunch. A loss of deposits may force banks to reduce lending to SMEs and households, hurting economic growth. Last, digital bank runs. During financial stress, the ease of moving funds to a CBDC safe haven could accelerate bank failures. Last point, the path forward. First, safe design. Use holding limits, caps on ownership or non-remuneration to prevent massive capital flight from banks. Next is the Dunbar example. Collaborative platforms like Malaysia's Project Dunbar show how multi-CBDCs can also fix cross-border payment inefficiencies. Final word, CBDCs enhance control but require a delicate balance to protect the credit creation role of private banks.
So, for the conclusion, digital currency like cryptocurrency, stablecoin and CBDC are really changing the way money and capital markets work. They make payments faster, cheaper and more efficient, and they also support Malaysia protocols in Islamic finance. Of course, there are challenges like market volatility, cybersecurity risk, and also potential policy impacts. So, this needs to be managed carefully. With proper regulation, Shariah compliance, and international cooperation, digital currency can strengthen financial stability, increase inclusivity, and make our financial system more resilient. Plus, as technology keeps evolving, ongoing research and adaptation will be the key to ensuring that these new tools remain safe, effective, and aligned with both global standards and Islamic finance principles. And that's all from us. Thank you.